Hello investors, welcome to Simpli Stocks. The earnings season is in full swing. Companies are releasing their Q2 or September quarter results back to back. And so far about 80 to 90% of the stocks in my portfolio have posted very good results. I have been bringing good businesses with excellent results to you here on YouTube as well for a week or 10 days now. This will be the fourth video in the Q2FY26 result series, and in it we will study 5 new businesses that have posted very terrific results. As usual, we will understand the business models of these companies, look at their results, and along with that, we will also try to know what their future looks like. But yes, please keep in mind, this video is in no way a buy or sell recommendation on any of these stocks. You must be mindful of this. With that, let's begin. The first business we will discuss is Timex Group. This has been my portfolio business for a year now. You must have heard of Timex. They manufacture and sell watches. They have their own brand, Timex, and besides this, they also sell watches of other luxury brands like Versace, Guess, Philippine, Adidas, etc. in India on a license basis. Timex is the biggest beneficiary of premiumization shift which is happening in India right now. People's incomes are rising. For example, according to Goldman Sachs, the number of people whose income is more than 10 lakh rupees is increasing at a rate of 13% right now. And what happens is when people's incomes rise is that they prefer premium experiences. They feel that even if they spend more money, the experience should be bit premium or they should get a luxury experience. Now, why did I say that Timex will benefit from this premiumization? So look, even though smartwatches are trending, but when a person gets money, the first thing they fix is their lifestyle, and they go and spend on good clothes and watches. They go and buy analog watches, meaning those watches with dials and hands. Amidst all this, I was also seeing that Titan's results came out last week, and in their PPT also they have mentioned that their analog watches sales increased by 17%. The volume growth itself is 12%. So that is also a very strong signal for us. Now let us look at the results of Timex. Their sales increased by 40% in the months of July to September, and there was an excellent 70 to 71% growth seen in EBITDA, profit before tax, and net profit, all three. In Q1 this year, Timex earned a profit of 15 crore, which increased to 30 crore this quarter. Profit growth is higher than sales growth, so we can say that it has also benefited from operating leverage. And if you are fond of watches, you would know that Timex is an affordable range brand. It starts from 3,000 rupees and goes up to 25-30,000. Good growth is coming in their Timex brand. Timex sales increased by 52%. Besides this, they are also working on premium watches along with the Timex brand. They have partnered with famous luxury brands like Guess, GC, Philippine, and to increase sales, they are working on all trade channels. E-commerce, which includes your Myntra, Amazon, etc., has seen a good growth of 53% year on year. Besides this, they have significantly grown their defense canteen business too. In the last 1 year, they have grown their defense canteens network by 35% from 440 to 595. Timex has rallied a bit recently, so I know you might be having your concerns around valuation. So for that, let us do this exercise. In the 6 months from April to September, Timex clocked 45 CR profit on 413 crore sales. Their H1 and H2 are almost equal. So by estimating the same 400 to 415 CR sales for H2, we can assume 800 crore sales for the whole year. The company's EBITDA margin in Q1 was 13%, which reached 17.6% in Q2, and the average H1 EBITDA margin comes out to 15.7%. Therefore, in my understanding, there will be good margin expansion in H2, and the profit after tax can be minimum 90 CR or even more. So even though Screener is currently showing you a PE of 70 because the company was at low margins last year, there were no significant profits. But on the estimated profit for this year, Timex is currently available to you at a forward PE of 45. This is a good valuation for a business growing at 40 to 45% rate. In brands, or take example of FMCG companies, you will not get such a valuation at such growth rates. And the premiumization shift has just begun. This business has a long-term potential. Many times people don't understand the margins or growth of a business. And then just by looking at PE on a screener, they say that so and so stock is overvalued. But later, that business keeps making new highs. And by the time they understand the PE on screener, it is too late. Because of this, it is very important for you to understand what is happening in the business. You cannot just look at screener or PE and make your calls. Now, the next business we will cover is a vintage coffee and beverages. We have been tracking vintage in our Simpli Stocks community for a long time now, and recently there was a fundraise in it too, which is when we covered this business on our YouTube channel as well. Vintage raised 216 crore rupees in funding, in which several FIIs and DIIs have invested. That is why you will see FII holding has increased from 3.9% to 5.3%, and DII's holding has also increased from 2.6% to 6.3%. Their results have been very good too. So let us quickly look at them again. So Vintage is an FMCG company, and as you must have guessed from the name, they manufacture and sell coffee. Vintage is a B2B player, meaning they manufacture coffee for other brands or companies. They are mainly export focused. Only 10 to 15% of their sales come from India. Southeast Asia, Russia, Europe, Africa, etc. are currently their main markets, and for future growth, they will be expanding into the USA, New Zealand, and Australia. Their Q2 results, meaning the results of these 3 months from July to September, have also been very good. And for the first time, the management held a conference call with investors. So when a company holds a conference call for the first time, it sends a very strong signal to the investor community. That is why, even if you have seen our previous video on vintage, I would say you should listen to this whole coverage again, because the management shared many interesting things in the conference call. Now let us look at the results. Sales increased by 90% compared to the previous year, reaching 136 CR this quarter. Profit growth has also been very good. Operating profit increased by 120% from the previous year, and 137% growth was seen in net profit. These are very, very good numbers. Honestly, I was not expecting that vintage would bring any growth this quarter, because you see, in the last 2 quarters, their sales were almost in the same 100 to 105 CR range. They were already operating at 100% capacity utilization, and the new plant is supposed to start in the upcoming March. But sales came straight at 136 crore in Q2. And the reason behind this is that the management did maintenance on the plant last quarter, so the production was low because of that. This quarter, they have reached capacity of 1650 metric tons. They currently have 6500 metric tons of spray dried and agglomerated instant coffee manufacturing capacity operational, and they are adding another 4500 metric tons of capacity, which will be operational in the upcoming March 2026. This will increase their production capacity by 70% from 6500 metric tons to 11,000 tons. And the management has stated with great confidence that they will increase production to 70-80% capacity utilization in the very first month. And then they will start operating at 100% capacity utilization from the second or third month. Furthermore, beyond this, the company is already planning for the next year. I liked this point about vintage a lot. They are bringing in another 5,000 tons capacity in the future, and this capacity will be for their freeze-dried coffee. They will get better margins here. So the margin expansion will also start happening in vintage down the line. So now listen to me. The company is currently at 6,500 tons, and 4,500 tons capacity will come by March 2026. That is next year. So then it will become 11,000 tons. This is your 70% growth. Then another 5,000 tons on top of this, a 45% increase is on the charts too. This plan will be completed by March 2027, and then the total capacity will be 16,000 metric tons. And talking about long-term plans, their target is to reach 20,000 tons capacity in the next 3 to 4 years. So we have a very good 40 to 50% growth visibility in vintage for the next 2 to 3 years. In the con call, someone also asked a question about promoter shareholding, mentioning that promoter shareholding has been decreasing in vintage. In response to this, the management said that company has been raising money for capacity expansion via equity, which is why the promoter's shareholding has been diluted and has decreased over time. But whatever money is needed for the freeze-dried coffee plant in the future, they will be taking a loan for that. There will be no further equity fundraise. Therefore, the promoter holding will remain stable in the future. So vintage is a good FMCG business that you should look at. The valuation is also very good, and their current CEO, C. Jawahar, has worked at Tata Coffee for 24 years. So the management is also very good, very experienced, and they are growing company quite well. Now, before we move on to the third stock, a humble request: if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Now let us come back to our businesses. The third business we will study is also a beneficiary of premiumization shift like Timex. The company's name is Allied Blenders and Distillers, and it is from the alcohol sector. Officer's Choice and Sterling Reserve are two famous whiskey brands of Allied. They launched iconic whiskey 2 years ago, which became quite a hit and has brought good growth for them. Allied has launched several new products in its super premium to luxury portfolio too. You will see their mass market to semi-premium range is between 840 to 1050 rupees. Their super premium range starts from 2400 and goes up to 5300 rupees per bottle, in which they have several new brands like Russian Standard Vodka, Zoya Gin, Woodburns Whiskey, etc., which are doing very well right now. And this premium alcohol portfolio in Allied is the main trigger for us. Expensive alcohols have gross margins of up to 40%. So even if just 1% volume growth here is equivalent to 10% sales growth. And we have seen this premiumization shift happening with Radico Khaitan and Piccadilly Agro, which have done very well. So now Allied Blenders is following playbook of Piccadilly and Radico. You will see that their premium alcohols contribution to their business has reached 50% sales wise and 40% volume wise. That is very good. In Q2, 31% sales growth was seen in the premium segment, but there was 5% degrowth in mass premium or regular liquor. This was because of policy changes that happened in Maharashtra. So see, alcohol is a very regulated sector and states can have their own laws. There was some disruption due to the increase in excise duty, but the 31% growth in the premium segment is the highlight of the results of Allied. That is why you will see that even though sales increased by 14.4% compared to the previous year, net profit has gone up by 32%. And due to premiumization, the EBITDA margin has gone from 12.1% to 13.1%. ABD's target is to bring mid-teens, meaning around 14 to 16% sales growth at the consolidated level in the future. Their portfolio is well prepared now, and they have brought Shreyas Iyer and Ranveer Singh now for marketing. From here, the company's entire focus will be on increasing marketing and its distribution. Besides this, they are also doing a capex of 525 CR to increase their manufacturing capacity for ENA, malt, and PET bottles. ENA is kind of a raw material for alcohol companies. So with this capacity coming in, their margins will improve. Currently, they source ENA from outside. Allied's current EBITDA margin is around 13.1%, and their target is to increase it to 17% by FY28. This 4% margin improvement will significantly boost their profitability. About 2% of the contribution here will also be from free trade agreement with England. Because of that, Scotch whiskey will become cheaper in India. This Scotch whiskey is used as a raw material in expensive alcohols. We will see that in effect from Q4. Their current ROCE is around 17%, which they aim to increase to 23 to 25%. So roughly, if we assume 15% sales growth in ABD along with 4 to 5% margin expansion, we can easily see more than 30% CAGR growth in their bottom line or net profit. So ABD is also a good premium bet that you can study yourself. Fourth business on our list is Blackbuck. This is a very interesting business model, and we are covering it for the first time on our Simpli Stocks channel. So this company runs a tech platform for truck owners or operators. They offer many different services, but if we look broadly at their business, they have two main business segments. One is the core business and the other is growth businesses. This is a slightly different model. Therefore, before understanding Blackbuck, we will understand the sector first, and then we will come back later to their services. So you would know that trucking or logistics is a very unorganized sector. There are many small businessmen across the country who run a transport agency with an average of 4, 5 or 6 trucks. Like you wouldn't know anyone in your circle of friends or family. But the problem in this business is that your truck driver or staff that works in the truck, like helper or cleaner, those people also remain completely unorganized. You cannot expect very disciplined or professional behavior from them. For example, I have a very close friend who has this transport agency only. So he often tells me that many times what drivers do, they do not deliver on time. They will stop at a roadside restaurant or dhaba, what you call, somewhere, and say that there is traffic jam on highway or something has happened to the truck. Similarly, they will get a higher bill or invoice from fuel station and will ask them to fill less diesel in the tank and steal the money, or they will simply sell the diesel by draining it from the tanker. So these are all very big problems in the trucking sector that owners have to face, and Blackbuck offers services for the solution of these very issues. The first thing that they do is they provide tolling and FASTag related services. They also offer GPS and tracking, so that if you are a truck owner, you can sit at home and see if the driver is going on the correct route or not, whether he is taking the justified route or not from where the goods were to be picked and where they were have to be delivered. Besides this, Blackbuck also has fuel cards, so that diesel of the whole amount you gave goes into the truck. The truck driver cannot do any kind of dishonesty with the pump staff in between. And to prevent diesel theft further, they have brought in fuel sensors, which keeps track of fuel level in the truck. These are their core businesses, from where about 80% of their sales currently come. Then they also have their growth businesses, which they have started recently. One of them is the superloads business. In superloads, what happens is that one are your regular goods that you can move with ordinary trucks. Then the second is bulky, heavy items for which you need trailers or large trucks with 6 or 9 axles. Suppose you have to move several cars, or you might have seen such pier caps, large parts in flyover construction, which are transported on very long trucks. Your regular truck will not be able to do this work. Now, because the material is so heavy and truck is so large, you will have to separately contact an agency that has the permit to drive such large and heavy trucks. Besides this, after finding the agency, a separate permit has to be taken from the RTO to move the goods. So this segment has also been very unorganized, but Blackbuck is now organizing it. If you have to move some very heavy equipment, Blackbuck will organize everything for you. Besides this, they have a classifieds business too, in which you can just go online and you can see that there are 4 or 5 operators. You can compare everyone's rates and finalize one. In classifieds, they connect truck operators to those people or companies who want to move their goods. These classifieds and superloads are their growth businesses. Their contribution to sales is low right now, but here growth is very strong. Like you will see here, their core business increased by 37% in the last 1 year, and in the growth businesses, a very strong 226% sales growth was seen on a smaller base. Therefore, their total sales growth comes out to 53%. So the company also earned a profit of 29 crore this quarter. Besides this, you will also see that they got operating leverage and margin expansion. Margin expansion plays out very quickly in technology or platform businesses. What happens is that, look, the expenses incurred to build the platform are one time. There is some expense for upgradation and maintenance, but the speed at which your sales will increase now once the platform is ready, that technology cost will not increase at the same speed. In this case, the margins will expand very quickly then. This graph shows the operating leverage strength of Blackbuck's business model. You will see how their EBITDA margin has continuously increased and reached 31.4% in Q2. Here you can also compare the H1 EBITDA margin of the last 3 years. In FY24, the margin was minus 16.4%. Mind you, in FY25, it became positive 16.4%, and this year it has reached 33.6%. This business is getting very good operating leverage, and I'm pretty damn sure it will continue to get it in the future as well. Besides this, all the other metrics for their platform, such as like how many operators are coming, how many services they are taking, and how many payments they are making on the platform, all these metrics have also shown very good growth. So Blackbuck is a very strong business model that you should definitely look at. It has a lot of scope in the long term. The fifth and final business we will study is Fedbank Financial Services, which many people also call Fedfina. It is a subsidiary of Federal Bank, and it is an NBFC, meaning Fedfina is in the business of giving loans. They specialize in two types of loans: mortgage loans and gold loans. In mortgage loans, if you need money, you go to the bank or NBFC and mortgage some land or your house. In gold loans, you mortgage gold. So these are their two loan segments. Their mortgage loan segment is almost mostly focused towards MSME, meaning small businesses. Most of its customers who come here are taking loans by mortgaging land or house for their business purposes. They previously also had an unsecured, meaning without collateral business loan segment, but many difficulties arose there and they scaled it down and have almost eliminated it. Fedfina has completely shifted from unsecured loans to secured loans. At a fundamental level, the management is still fixing many things. It is in the transition phase. That is why you should not look at it from the perspective of a perfect NBFC. You have to be patient here and see whether things are going in the right direction or not. In mortgage loans also, they give two types of loans. One is these small sized loan against property and housing loans, which are in the range of 10 to 20 lakh rupees. The second is medium ticket size loans against property, which is around 60 lakh rupees. Fedfina now has almost 700 branches across the country, out of which most of their branches, 550 approx, are for gold loans and around 150 are for property loans. Talking about their geographical presence, Fedfina is mainly more prevalent in South and West India. What has happened is that due to the rise in gold prices, the demand for gold loans is also increasing. You see, with the rise in gold rates, what has happened is that customer can take a bigger amount of loan for the same quantity of gold. And there, the bank or NBFC can also give more loans, bigger loans, and earn more interest income. According to RBI data, the demand for gold loans has grown by 122% from the previous year, or it has more than doubled, so to speak. This means there is a very fast growth coming in this whole gold lending sector. Besides, with the increase in prices, the loan to value ratios of lenders also improve. So they have benefited from that too. Loan to value ratio basically means, let's say you mortgage gold worth 100 rupees. The bank or NBFC can give you a loan of 80 rupees. So that ratio has improved. One more benefit that gold lenders have received is that the RBI has become quite strict on unsecured lending, meaning your loans without collateral. Because you see, loan defaults have increased in the microfinance and unsecured lending in the past 1.5 years. Therefore, to keep risk under control in the sector, several checks and standards have been implemented. In this situation, the demand for personal unsecured loans has decreased and the demand for gold-backed loans is increasing because people need money for some reason or the other. Now, they won't get a loan without collateral, so the next option left is to mortgage gold. This video is getting a bit lengthy, so let us quickly come to Fedfina's results. Their branch network has grown by 5% in 1 year, and disbursements, meaning how many new loans the company is giving, this number has increased by 37% from the previous year. AUM, meaning the total amount of money given out on loans, that number is up 13.5%. The AUM growth might look weak to you, but as I told you, they have scaled down the unsecured business loan segment. Because of this, this growth looks low. Otherwise, if we remove its impact, the AUM has grown by a good 28% rate. Total interest income has increased by 3.3% and 24% growth was there in net profit. I will stress again here that you need to understand the direction of the business. Now, there is some movement in NPAs, but that is not a very big deal. In this screenshot, you will be able to notice how they have reduced the business loan segment from almost 1900 crore to just 375 crore in 1 year. There is 22% growth in mortgage loans. The main trigger here is their gold loan segment, which has recorded 36% AUM growth. Gold loans share in total AUM has become 40% since the gold loan segment now has a big share in the business. So future growth rates will be better in Fedfina. I hope you found this video helpful, and if you did not like the video earlier and if you did not subscribe to the channel earlier, my earnest request, please do it now. This is my only motivation so that I keep working hard for you. I keep bringing these results to you. I'll see you in the next video. Happy investing.